In a significant turn of events, China's real estate landscape was jolted when Evergrande, the world's most indebted property developer, filed for bankruptcy on August 17, 2023. The company's choice to file for Chapter 15 bankruptcy protection in a U.S. court adds a layer of complexity to the unfolding crisis. With over $300 billion in liabilities, the implications of Evergrande's bankruptcy are far-reaching, impacting not only China's economy but also rippling through global financial markets. A year-long crisis. Evergrande's bankruptcy marks the climax of a year-long crisis that has been brewing since 2021. The company's troubles stemmed from a confluence of factors, including a sluggish Chinese property market, escalating operational costs, and a liquidity crunch. This perfect storm led Evergrande to default on its debt in December 2021, propelling the company into a desperate struggle to avert bankruptcy. Chapter 15 filing. A glimpse into restructuring. Seeking a lifeline, Evergrande filed for Chapter 15 bankruptcy protection, aiming to reorganize its massive debt load under U.S. law. This step serves as the initial phase of the company's restructuring process, as it endeavors to broker agreements with creditors to alleviate its financial burden and continue operations. However, the path ahead is neither straightforward nor swift. The intricacies of the restructuring process pose a formidable challenge, and the duration of Evergrande's emergence from bankruptcy remains uncertain. Impact on China's economy. Evergrande's bankruptcy reverberates within China's economic framework. As a pivotal player in the property market, its collapse casts a shadow over other businesses and industries linked to real estate. The aftershocks extend to suppliers, contractors, and financial institutions entwined in Evergrande's expansive network. This fallout carries the potential to weaken consumer confidence and investment sentiment in China, potentially denting the nation's reputation as a reliable destination for investment. Global ripple effects. While the full extent of Evergrande's bankruptcy's global impact remains enigmatic, it undoubtedly sends ripples across international financial markets. The interconnectedness of the global economy ensures that the reverberations will extend beyond China's borders. As investors grapple with uncertainty surrounding China's economic stability, markets worldwide may experience heightened volatility. The event raises questions about the vulnerability of the world economy to shocks emanating from major players in emerging markets. Evergrande's bankruptcy marks a watershed moment not only for China's property market but for the global financial ecosystem. The culmination of a year-long crisis, coupled with the complex restructuring process, signifies a challenging road ahead for the beleaguered company. The profound impact on China's economy, reputation, and global financial stability serves as a reminder of the interconnectedness of economies in an increasingly interdependent world. As China navigates this unprecedented juncture, the world watches intently, acutely aware of the far-reaching ramifications of Evergrande's bankruptcy. In a week that sent shockwaves across the financial world, global shares suffered their most severe setback since March. A confluence of factors, from interest rate anxieties to geopolitical tensions, has triggered a wave of uncertainty, leaving investors and experts alike on edge. This article delves into the pivotal events of this tumultuous week, shedding light on the reasons behind the market turmoil and what they mean for the global economy. Interest rate worries drive market sell-off. The unsettling chain of events commenced with a stronger-than-anticipated U.S. jobs report on Friday, prompting concerns about heightened inflation. As a response, expectations grew that the Federal Reserve would adopt a more aggressive stance in raising interest rates to curb inflation. This shift in monetary policy, in turn, raised borrowing costs for companies and governments worldwide, fueling apprehensions about economic growth prospects. Notably, the yield on the 10-year U.S. Treasury note reached its highest point since 2018, exerting further downward pressure on investor sentiment. IMF warns of economic headwinds. Compounding the market distress were the cautionary words from the International Monetary Fund, IMF, which issued warnings about multiple global headwinds. Factors such as the ongoing conflict in Ukraine, surging inflation, and a slowdown in China have introduced substantial uncertainties into the equation. These combined challenges are likely to keep investors cautious in the weeks and months ahead, as they grapple with the potential ramifications for the worldwide economy. IMF resumes aid to Ukraine. However, amidst the turbulence, a glimmer of stability emerged as the IMF announced its decision to reinstate financial assistance to Ukraine. This positive development follows Ukraine's successful submission of a fiscally responsible 2023 budget that aligns with the fund's criteria. The commitment of $3.9 billion will prove instrumental in addressing the nation's budget deficit and restoring economic equilibrium. This decision reflects a vote of confidence in Ukraine's proactive economic policies and signals progress in reducing deficits and improving public finances. Nonetheless, challenges remain on the horizon, including the ongoing conflict with Russia and the broader economic slowdown. China's delicate balancing act. Meanwhile, China found itself in a precarious position as the People's Bank of China, PBOC, took steps to stimulate its economy. The central bank opted for a conservative approach, cutting the benchmark one-year loan rate by 0.25 percentage points to 3.75%. This decision fell short of the 0.5 percentage point reduction anticipated by many economists. Additionally, the PBOC maintained the mortgage-linked 5-year rate at 4.6%, hinting at a cautious stance. This measured approach by the PBOC underscores its concern about mounting inflation risks, which have reached a 2-decade high. As China's economy experiences a gradual deceleration, calls for further stimulus grow louder. The possibility of a global recession looms, prompting experts to closely monitor economic indicators in the upcoming months. Should conditions worsen, the PBOC might be compelled to implement more drastic interest rate cuts to jumpstart economic activity. Conclusion. The tumultuous week in global markets serves as a stark reminder of the intricate web of factors that impact economic stability and investor sentiment. From the reverberations of unexpected U.S. job data to the delicate balancing act of central banks, the intricate interplay of economic and geopolitical variables underscores the challenges faced by today's interconnected world. As the coming weeks unfold, global financial markets will remain on edge, closely monitoring developments to gauge the trajectory of the world economy.